I've really noticed, since I am one of the few asset managers that's actually public on social media, that there's a massive disconnect between what people think trading investing looks like and then what is actually happening, behind the scenes in the institutional world. Because ultimately, I had to learn that the hard way myself. You can't learn most of these things just on YouTube or anywhere. What I want to do is kind of break down 5 strategies that hedge funds use, some of the biggest names, whether it's a Dalio, a Soros, a Howard Marks, you name it, and ultimately share that with you so that you can find ways to apply that to your own investing. So, hedge fund strategy number 1. The long short. This is a very simple strategy, a very straightforward strategy, but one that is rarely ever practiced by retail traders. Earlier this year, I found that in the crypto markets, there are 2, let's call them layer 0 protocols. One is Cosmos, also going by the token symbol Atom, and one is Polkadot, going by the token symbol DOT, right? And at the time, I found that while they are competitors, both trying to be this layer 0 protocol, one, Cosmos, had about 100,000 active users. At the same time, Polkadot only had 1,000 active users. Yet ironically, Polkadot was worth about 3 times as much as Cosmos was. Even just that simple setup. Triple the value, yet only 100th attraction was a great setup to say, hey, what if I go long Cosmos and short Polkadot? The setup is interesting because I have 2 choices. A lot of times people just go long. Now, what happens if the market goes down, right? Like in a bear market, you're still tied to the overall market movements, the beta. But by adding a short to that equation, you're able to cancel that out to a degree. And so you shouldn't have lost anything. The way you make money on the long short is by actually having an edge, right? Where you say, over a certain amount of time, my long should go up more than my short. Or in a bear market, over a certain amount of time, my long should drop less than my short. So interestingly enough, with that specific trade, when we entered it, the ratio was about 1.2. And by the time we exited, it was about 2.0. That was an appreciation, of somewhere to the tune of 60%. What you're essentially doing is you're finding an asset that you believe is undervalued. And then you find one that you believe is overvalued. You long the asset you believe is undervalued, and you short the asset that is overvalued. Number 2 is activist investing. And I did this myself back in 2020 when DeFi summer just got started in crypto. I said, hey, let me go find some distressed assets after this bear market. And I came across a project back then called Melon Protocol. Today it's called Enzyme Finance, where Melon was going from 200,000 in total assets on platform to 800,000 assets. It had a very small market cap, maybe a $3.5 million market cap. But I said, hey, this product is starting to see small amounts of traction. It's growing, right? Incredible leadership. Talked to the founder, ex-Goldman VP, traded book of over $1 billion, super dedicated. But at the same time, there was a few things broken, as I did my research. On one hand, the token had no purpose. Most were saying that this token pretty much didn't have a token model, and so that needed overhauling. And at the same time, it was also not really decentralized, which is the whole point of crypto projects. And so I said, hey, this is an opportunity here where I can come in as an activist. Let me buy up a good chunk of the network. We bought up maybe 2 or 3%, and then force changes on those things. I kept bothering the team until we held the first publicly held elections. And of course, because I was so active in that whole process, the committee elected me as one of the first council members. And so I was a council member for 2 years. At the same time, I started contacting, all the thought leaders in the space about thinking about a new token model. And ultimately, 2 weeks later, Tom Shaughnessy, one of my friends here, one of the founders of Delphi, ended up writing a new token model along with 2 other people within 2 weeks. And so within a very brief amount of time, I was able to, take a large stake in the network. We set up one of our own on-chain funds to, help push TVL. We helped to create a new token model. I took a board seat, had an active role in the governance and so forth. And, from that entry, even though we're in a bear market now, even today, that asset is still up over 5x from the entry. It was up a lot more even before then. And so the cool thing is with activist investing, all you have to do is find an asset where you actually can have a meaningful input, right? So I am no Bill Ackman, I am no Carl Icahn, I don't have billions of dollars to sling around. But even as a crypto fund, I was able to find a small cap project where I can play a big role, and that was one of my big trades. So you can find whatever asset works for you. Just make sure that you always put quality first. Just because something is cheap does not make it good. You'd rather pay a little bit more, but make it a good asset. Number 3, special situations, or sometimes also called event-driven trades or catalyst trades. Back in 2020, in December, the SEC charged Ripple. They started indicting them. They started launching a case against them saying that, hey, Ripple, you are a security. So my mind raised and I said, okay, if that is the case, what would happen? And I realized that if Ripple is a security, one, a lot of exchanges would need to delist them, and they would probably get kicked off of a lot of funds and so forth. And so there would be a large unwinding of assets. And exactly that happened. So when it happened, I remember I got a notification, I saw the lawsuit happened, and right in there entered a trade where I entered a short at, let's say, 48 cents. And within 48 hours or so, it was only a couple days, Ripple traded all the way down to 16 cents. The token dropped 60 to 70%. Or more recently, on a war room, we shared how we were bullish on SushiSwap. At the time, SushiSwap had a new CEO elected, Jerry Gray. At the same time, they had an old investor that caused a lot of ruckus with the community, getting filtered out, they sold. And then you had a new backer come in, Golden Tree, right? And so these were three events that really provided some momentum for that token, that project. And so we decided, hey, that is a great special duration trade. Let's enter. And we bought perhaps sushi at, I think it was like at $1.20, and we sold most of it about $1.70 before the FTX collapse. I've done countless of these trades. To me, those are like the bread and butter, because the great thing about them is they work in bull markets, they work in bear markets, they work in sideways markets, because you're trading around events that are idiosyncratic. It's just about them. It's not about the greater market. And these are also often shorter term trades. All what you're really doing here is you're trying to trade around specific events happening. Number 4, I'm sure you've heard of this one, macro. Macro traders and investors, they are all the time on CNBC. They're always on TV. Why? Because they've got interesting theses to share. Generally, macro investors, macro traders, they care less about individual stocks, individual cryptos, and they also care less about, what a chart is looking like today. They tend to zoom out, and they tend to care about large events. One time when macro investors really shone was during COVID in 2020, because there's a lot of people that saw that this virus could be a potential threat. And so there's many people that traded around those events and said, hey, if this pandemic, if this macro event happens, right, and becomes global, what could that lead to? There were funds out there shorting cruise lines. There was funds out there shorting hospitality. There was funds maybe longing assets in pharma, thinking that they could benefit from maybe discovering a drug solution. With macro, it's all about like kind of painting that bigger picture of where's the world going in the next 12, 24 months. We're talking geopolitics, we're talking interest rates, we're talking world events. Anything that would really impact the world at large. So this is something you could easily do even as a retail investor that doesn't require a big book. But the great thing is it does scale even to big books where, some of the greatest macro investors are George Soros, who famously made as much as $1 billion in a single day for breaking the Bank of England, betting against the pound sterling and the British economy.
That bet has been available for the last 10 years. And it only paid off at that particular moment.
Last but not least, number 5, arbitrage trading and quantitative strategies. Now, not everything in markets is purely fundamental. Not everything is done by man. But instead, there are many strategies that actually do deploy, for example, automated systems, algorithms. Fund managers that use arbitrage tend to be what's called market neutral. They try to perform no matter what the market does. If the market goes up 100% tomorrow, they probably still make only, let's say, 10%. If the market goes down 50% tomorrow, they probably still make only 10%. And so their goal isn't to match the market, but instead perform in a market neutral fashion. How can you do that? Another incredibly well-known hedge fund manager, Jim Simons, who at the time at least was the biggest hedge fund in the world, Renaissance Technologies, incredibly well known. His whole team is made up of PhDs. His incredible book about his life as well, The Man Who Solved the Market. He predominantly focused on statistical arbitrage. Let's say they identify a basket of different equities that tend to trade in unison. They tend to trade very, very similar. And maybe one of those assets kind of like goes out of bounds of that basket, and their bet is that there's mean reversion, meaning that it goes back to where it should be trading. And they're doing that at scale, they're doing that in mass, and they're using very complex algorithmic models to do so. Statistical arbitrage, of course, takes a lot more skill. It is worth noting that Rentec is run by some of the brightest people in finance, and they've been returning, I believe, an average return of 66% for something like 40 years in a row, which is incredible, which is also why Jim is able to charge a 45% performance fee, which is quite a fee. There's been times when one of my analysts showed me, hey, on one different chain, a token was trading, let's say 30% higher. But maybe the liquidity pool was so small that if all I could do was, arbitrage $3,000, it's not really worth it for a fund of our size, right? And so we might cleanse over this, but this might be an opportunity for you. So maybe you can say, hey, how are some smaller caps mispriced on different chains that, bigger funds aren't even paying attention to because it's just not worth it for them, but maybe you can arbitrage it. Arbitrage goes away over time. And so now most of these exchanges are trading almost at equilibrium. And so that has been fixed away. Maybe in the future, we'll start seeing more and more NFT arbitrage. But anytime there is a new investment sector coming up, be ready for there to be mispricings that can be arbitraged. So whatever fits you, that might be a great starting place, but overall would be super helpful, I think, for anybody who's serious about the world of trading and investing to learn about all of these and see how you can use them, how you can fit them into your trading practices. Because ultimately, any of these, if used properly, can yield much more consistent returns and a much better approach that's also scalable once you become larger, compared to simply looking at charts and trading breakout patterns and trading flags, because ultimately that simply won't scale you to the level where you ultimately want to go.